Hi, this is Pete Birchler of StockMarketAlchemy.com. Today is actually June 18th, Wednesday evening after U.S. markets closed. It's been a while since I did an update for the YouTube here, and I wanted to just give an opinion or a take on what's going on here, possibly a significant point in the markets. Time will tell, obviously, but for right now, I want to go over a few details on this chart of IWM, which is the Russell 2000 index ETF, and look at a few related charts as well. So the first thing noting here is a dual time frame momentum setup that would be indicative of a potential topping pattern for the market here. So first off, if we look at a couple other markets, so this is the Russell 2000. Let's zoom in a little bit here. We can see that currently, even though the market's been strong here recently, the Russell is still below its high from the spring. And so it's not confirming, if we look over here, the S&P 500, quite a bit above its high from the spring. If we look at the NASDAQ, broke out above its spring high here over the last few weeks as well. If we look at the Dow, above its spring highs as well by a good bit here. So we have the Russell lagging behind on the rally, and it was a major leader in this last advancing phase over the last couple years. And secondarily, I want to look at the technical setup here. And this chart of the Russell 2000, this is a weekly chart. So this is going all the way back to late 2009, early 2010. And I just want to draw a potential similarity to what's going on right here, just on a technical basis, and what happened here going into the highs in 2011. So if you look back in 2011, there was this rather extended, very trendy advance from basically August up into the May peak. And then we saw the Stochastics get overbought and more or less maintain in the overbought area for the most part until towards the highs. Saw a little dip down back below the 80 line here in March of 2011, and then form a divergence pattern here, which means the indicator, the Stochastics, came to a lower high relative to here, yet the price made a higher high relative to here. And so that was our divergence pattern, which in retrospect gave us a topping signal on the weekly chart. And then if you look after that, a couple of significant things happen. One is that this advance down off of the high, this first initial break or crack, so to speak, actually was significantly bigger than anything else that had happened since late August of that time frame. And we're seeing somewhat a similar thing here in the Russell, and we've had this very trendy advance, which in some ways is trendy, in some ways has had a relatively low rate of decline. So it's certainly some case for mixed opinion here on whether this market still has room to go in it. But in any case, if we just look at the technical indicator, we have this relatively extended period where the Stochastics is maintaining mostly in the overbought region with very, very brief pullbacks. Then we see a little bit sharper decline here preceding the high, and we have this break of the Stochastics that kind of corresponds to this one here. Then we have a rally to a new high, but there's this divergence pattern, so the Stochastics reaches a lower high. Now we've seen a sell-off here in the Russell 2000, where if we just draw this line here in price and time, which is larger than anything else we saw since the correction in late 2012 there. And so here we are now rallying back up, and in both cases we see the Stochastics here rallying back up, and it's at about the same level as it was where it peaked on the right shoulder of kind of a head and shoulder pattern that happened here. And then once we saw the break of that support line in kind of a traditional head and shoulders pattern sense, we saw the market sell off sharply. So this blue line here corresponds with this kind of double bottom here, short-term double bottom, potential neckline of a head and shoulders pattern, kind of corresponding to this area here. And here we are with a shoulder on the right side, which very often will equal or slightly exceed the shoulder on the left side. So that is the weekly chart setup here, and just drawing an analogy to past market action at the current time frame. Now what I want to do is zoom in and look at this a little bit closer, because Here we have potentially a powerful divergence top pattern, initial break, and kind of an overbought at a lower high signal. And if we zoom into a daily chart now, we can see that here on this last move up in the Russell since May, we're seeing a similar thing where we're seeing now a divergence pattern in the stochastics on the Russell 2000. So on this break today above the highs from a week ago or so, the stochastics is at a lower high. Now, we don't have any reversal down in the market yet to indicate that the market is rolling over off this level, so we don't want to jump the gun. But at the same time, we are seeing a daily time frame overbought with divergence, while the weekly chart is potentially giving us a sell type of setup. If we look at some other markets, if we just look at the S&P 500 here briefly on a MACD chart, we can see that there is a kind of a large-scale divergence type of taking place here, and that we saw a peak in the MACD back here around the New Year time frame, and we saw a bit of a higher high with the divergence, and then just a brief sell-off in the S&P 500, though it was more substantial in the NASDAQ and in the Russell. Now we're seeing it cross back up, and so the question is this just kind of another beginning of a new trend, kind of like we saw at some of these other cross points here, or is this more like what happened here in 2011, 2010, where we had kind of a sloppy looking, especially this one here in 2010, where we already had kind of a mild divergence going into this high, a brief sharp sell-off, and then a run up to new highs before a major correction. So I would say, just based off of the indicator setups here in the Russell that we just looked at, being at a non-confirming overbought lower high with a potentially significant overbalancing in price and time on the recent correction. And then if we have this here on the S&P 500, we have this kind of sloppy large-scale potential divergence pattern that is similar to these ones here. So that being said, what will happen from here? Not sure, but one of the some of the gauges I use to look at that are some sentiment indicators, and I'll take you through briefly a couple things here. There's a bit of a mixed bag here. First off, looking at the VIX, we can see the VIX is very low. It's at the today is the lowest point that it's been in years. If we go back on the VIX, we can see this is the lowest it's been since 2007, where the stock still had close to a year left in them before topping. So the VIX being at a new low isn't necessarily a major long-term signal, because what we often see is some type of a divergence pattern in the VIX where the market continues higher, but the VIX also is making higher bottoms. We aren't seeing that yet, so I don't know how significant this will be. But if we move into a daily chart, we can see that recently the VIX closed, 2 times recently, the VIX closed outside of the lower daily Bollinger Band on May 23rd, and then here on June 6th, and then today it closed right at the lower Bollinger Band again. So we're having a cluster of signals right here where is potentially we're seeing the VIX kind of crowding that lower band and hitting a statistical extreme. And when we've seen prior times like that where the price closes at or below the bands several times in a period of a few weeks or a few months, a lot of times we're at a point where we could anticipate a more significant pullback. So that's something to look at here. Looking at the VXV, which is similar to the VIX but runs on a 90-day scale instead of a 30-day scale, we can see the VXV is below its daily or 20-period Bollinger Band, below its 126-period Bollinger Band as well, and this would indicate that on a long-term basis, this may be at a relatively low VIX level. And if we don't see a major correction right now, we would at least be wise, I believe, to look for divergence patterns where we see stocks continue higher and see these volatility indexes fail to make significantly lower lows. So if we aren't at a peak level right here, if we don't see the market roll over, I would continue to just view this as a sign that the market is unfolding in a way it typically does prior to a major correction. And if you are a person who trades only long in stocks, then the conclusion of this could simply be that you're going to continue to move stops up below any daily chart support. or you're going to use some type of automated trailing stop methodology that will continue to lock in profits if the market moves higher. That way you can maintain yourself with the trend. I've made past videos and given ideas on how to use both MACD as a stop loss adjusting mechanism and also using a moving average channel as a stop loss adjusting mechanism. So those are also ways that you could look at it as well if you're on the long side here of looking how to continue to move stops and let the market run. And then another indication would be if we continue to see more glaring divergence patterns develop on a large scale. My personal preference is to exit at least partial exits into strength when we're seeing extreme signals with divergences, just because with studying these type of topping patterns a lot, I often feel that I get better exits more near to the high than waiting for the stop loss to take me out. The flip side of that is when you do get major trends that continue and move much further than you think you are and can really make you those big trades that kind of make all of your profit. If you exit all of your position on those, then you don't ever capture that huge run that occasionally happens. So I think it's wise to balance strategies by exiting into strength consistently at objective signals, and then also using a trailing methodology and use that on a part of the position. One of the main indicators I look at in gauging topping patterns is the total put to call ratio relative to just a Bollinger Band type of setup, and I use a 5-day moving average of the total put to call ratio, and I use a standard deviation band of 1 standard deviation instead of 2. And what we're seeing here is the ratio is getting towards its lowest levels, as low as we've seen it going back to well, this is the lowest that the average has been other than right around New Year this year. And so just based off of historical levels, it is relatively low. And what we're not seeing yet is no move outside the lower Bollinger Band. And really over the last few years, we have consistently seen some readings outside the lower Bollinger Bands prior to the more significant corrections that happened in the market. So I don't think that has to happen for the market to make some type of a correction, but in any case, that would be an argument for continuing to allow this market to move to the upside and at least maintaining partial positions with a trailing type of mechanism until we see a more extreme reading from this measure. This is another way I look at the total put to call ratio, and this one is just showing some moving averages of the ratio and then showing an oscillator type of setup here, with the main point that when we see the ratio get this oscillator get very low and then form a divergence type of pattern, that we are near to a high in the market typically. So we're seeing the oscillator get to a low level, yet we're not seeing a significant divergence pattern develop yet. So again, the market may still have some room in it to the upside, but we're probably getting to that point where the better portion of the run is done, and we may see some more gains, but probably not, in my opinion, likely to be as significant from now to whatever high may form as the gains we've seen here in the past. This is a longer-term view of the total put-to-call ratio with some longer-term moving averages and standard deviation bands, and we can see that the put-to-call ratio is moving lower, which means there is less fear in the market, more complacency in the market, and typically ebbs and flows as the market moves higher. We see complacency get more significant, and we see the put-to-call volume start to dry up. So if we see this continue lower here over the next several weeks, that may be another indication that the market is at an optimistic extreme. But just comparing to the past few years of data, we can see that this average here is lower than anywhere, than any of the reading it has been, other than right around New Year's this of 2014. So again, just compared to historical levels, this may be considered to be at a low level. But we have seen it move lower, and we have seen it move outside the standard deviation bands before. So another thing we can continue to watch moving forward. On a long-term basis, one of the things I track is the advanced decline line in terms of looking for major turning points. And we can see that the advanced decline line is at a new high here and there is no divergence pattern like we saw at the top of the last bull market. So the bull market that peaked in 2007 peaked in October, which is here, and but we saw the advanced decline peak earlier in the year. So right now we don't have any significant divergence pattern like that. The flip side, though, is if we look at the bear market bottom, which occurred in 2009, we didn't see any divergence develop on the advanced decline line there, because this was the date at which the low formed. But on a technical level, we did see some very strong divergences. So we're kind of in the reverse scenario here, where we're not seeing any divergence in the topping type of divergence in the advanced decline line, but we are seeing potentially a relatively sizable divergence pattern in the technical indicators like the MACD that we just looked at. So again, some mixed signals here. One thing I would point out here, and I kind of keep track of intermarket correlations as a market unfolds to help gauge turning points. And a couple points of note here. One is the gold market, and we move over to a chart of the gold market here. And the point being, if we look at, hang on a second while this pulls up. This is a chart of continuous gold prices, and what I'm going to do is put a comparison on here with the S&P 500. With the point being that, and let's bring a vertical line in here. There's been some inverse correlation in that we saw here at the peak prior to this correction into February. So this is the stock market peaking. The gold market was making a low, and looking back into the August time frame here, we saw the gold market peaking while the stocks made a low. So there's been somewhat of an inverse correlation, and it's not a very strong correlation. But right now we're seeing gold seeming to make a relative low and showing some signs that it may reverse to the upside, and we're seeing stocks potentially at a relative high. So just based off of some of the significant turning points here over the past year, the way the correlations have been working, I suspect that if we do see gold turn up, we may then see stocks correct a bit. However, those correlations change over time. I just wanted to point out that is significant because I think there is some significant opportunity in trading the gold market here. I think it's actually a pretty nice buy setup currently. And so if you're one who's trading long, part of my point in bringing this up is that maybe you want to get out of stocks currently as we're seeing the market rise, but consider moving into the metals like the gold or the silver. Another point I wanted to look at here in terms of the oil market. If we move to a daily chart of oil prices and zoom out a bit here, we are seeing oil prices seeing the stochastics overbought, and we could see possibly a correction from here. And on a pattern standpoint, I'm looking at this box here. So basically, we're right in the middle of this now, but from now till the beginning of July, as being a potential topping time for a price pattern up in gold going back to in oil going back to November. So something to monitor here. And then moving out to a weekly chart, we can see that even as the oil prices are making higher highs here, the stochastics indicator is at lower highs than it's made earlier in the spring. So possibly even some weekly time frame divergence developing here, and the significance of that is that this is a divergence developing at a lower high, so lower than the prices were last summer. So anytime we see divergences developing at a lower high, there's potentially some significance there. Another simple tool I use is what I refer to as price logic, but to look at the time of the relative declines in advancing phases, and we can see that currently in oil, the move up since this low in January has taken longer in time than this prior correction, and it's not completely moved to a higher high. So this is somewhat of a slower rate of advance, and we're seeing some divergence develop here. These are types of setups where we could potentially be looking for a short side setup. Again, not wanting to jump the gun here, we need to use objective signals, but just looking at some of the correlations of the markets, if we do see stocks roll over, it appears to me that we might see oil move to the downside, possibly see gold move to the upside. Lastly here, looking at the bond market. This is a weekly chart of TLT, which is a longer-term bond ETF. It's been in a nice uptrend here, and has currently found some support at the lower boundary of this moving average channel right here. And so the question again would be, typically there's an inverse correlation in that as we see stocks move higher, we see bonds move lower. We haven't really seen that for the most part this year, though there's been some mixed correlations. Moving into a daily chart, the question is whether we're likely to see stocks continue higher and bonds continue lower, or is this brief sell-off here in the bonds just a relatively measured correction in a trend? And if we do see stocks roll over, are we likely to see bonds continue to move higher, which is oftentimes the correlation we've seen over the past number of years, but that correlation has seemed to break down to some extent over the past few months, and then we've seen stocks and bonds move higher to a significant extent here over the last few months. So that's really my take on some of the markets here. Primarily just wanting to get an update here on YouTube and show that I do think there's a potential setup here or inflection point in stocks. Some of these other markets I didn't review as intensively, but again, make sure if you are trading, you're using objective signals for your trading entries, and make sure if you are holding stocks or holding positions that you're having some type of trend following mechanism to allow yourself to capture big trends. So you want to really let those gains go, use some type of a moving average channel or some type of movement strategy or trailing stop methodology to help you capture more profits in the market. And then if you're going to trade counter to the obvious trend of the market, like we looked at in stocks here, they're clearly in an uptrend. My preference is at a bare minimum that you have a multiple time frame divergence to trade counter to an established trend. So if we are looking at, let's look at the SPY chart here. So if we're looking at a long-term upwards trend, we want to see both weekly time frame overbought signals with divergence and a daily time frame overbought signal before we even consider trading counter to the trend. My preference and favorite setup at a trend change point is something like we're seeing in the Russell here, is that we're actually seeing some overbought and divergence at a lower high after a potentially larger timescale overbalancing type of correction in the market. So this is the type of setup we typically see. We will see if it actually unfolds into anything significant here to the downside. In terms of significant support levels, I would view, just based off of this chart, almost three significant bottoms here, but definitely two significant bottoms here in the Russell, having stops below the May low in the Russell 2000 being your line in the sand, that if we see prices come back down and close below that level, that may very well be it for this run up. Doesn't necessarily mean the bull market's over, but we've already seen move down from 120-ish to 107 or so, about a 10% correction in this market. So if it moves down another 10%, we're looking at a 20% correction. If it goes much further than that, then you're talking bear market territory. And so I would use this as my line in the sand in terms of stop losses if you consider yourself more of a longer term holder and you just want to maintain stocks as long as they're in an uptrend. That's my line in the sand to you right there. So hopefully this update is helpful to some extent, and if there are any questions on any specific markets, please just leave a comment below the video. If there's any other information you'd like to see that I routinely show in the past but I didn't show in this video, again, leave me a comment with that specific request, and I'll also put this video up on the blog stockmarketalchemy.blogspot.com. Welcome to leave me a comment over there if there's any other information that you like, and also, if you have any interest in any specific stocks that you're looking at, if you drop me a comment or something with the tickers there, I'd be happy to take a look at those and try and get back to you either through the comments or a video. So with that being said, I'll let you go. Have a great day, and wish you all the best in your trading.